London has just executed the fastest physical gold drain in over a decade, and the silence from mainstream financial media is deafening. Between mid-October and mid-December, more than 1,000 metric tons of gold vanished from LBMA vaults. That's not a seasonal adjustment. That's not portfolio rebalancing. That's a structural shift in the global monetary order happening in real time while central banks tell you inflation is under control and the dollar remains king. The London Bullion Market Association holds the largest pool of physical gold outside sovereign central banks. For decades, it's been the liquidity backbone of the Western gold market. When 1,000 tons moves that fast, someone knows something. The question isn't whether this matters. The question is what they're preparing for that you haven't been told. This isn't just about gold. This is about trust, about the architecture of reserve currency systems, and about what happens when the countries holding dollars decide they'd rather hold metal. What's happening behind this decision goes far beyond normal market flows. Asian buyers are paying premiums over spot price for immediate physical delivery. That doesn't happen when markets are functioning smoothly. That happens when counterparty risk is rising, when confidence in paper claims is falling, and when sophisticated actors are moving first. Wall Street analysts are calling this normal volatility. Central banks are saying nothing. But the vaults in London are emptying at a pace we haven't seen since the European debt crisis shook confidence in the entire financial system. This move signals a breakdown in the mechanisms that have kept gold suppressed and the dollar dominant for 50 years. For anyone holding cash, for anyone with savings in a bank, for anyone who believes the financial system is stable because authorities say it is, what's unfolding in London right now is a warning you can't afford to ignore. But first, we need to understand how London became the center of the gold universe and why that system is now being torn apart from the inside. To understand why this moment is so crucial, we must go back to 1971. That year, Richard Nixon severed the final link between the dollar and gold. The Bretton Woods system collapsed. But the dollar didn't collapse with it. Instead, Washington engineered a new arrangement. The dollar would be backed not by gold, but by oil, by military power, by the depth of treasury markets, and by a global financial architecture that made it nearly impossible to do business without touching dollars. London played a unique role in this system. While New York housed the Federal Reserve and the primary dealers, London became the hub for physical gold trading. The LBMA emerged as the world's largest over-the-counter gold market. It wasn't just a spot market. It was a mechanism for central banks and bullion banks to manage global liquidity, to suppress price volatility, and to ensure that gold remained a pet rock rather than a monetary competitor to the dollar. The way it worked was elegant. Large commercial banks held physical gold in London vaults. They issued paper claims against that gold. Those claims traded globally. Futures contracts, ETFs, unallocated accounts. All of them were derivatives of the physical metal sitting in London. As long as redemption requests remained low, the system worked. Banks could issue far more paper claims than they held physical metal. They could suppress the price through futures market manipulation. They could ensure that gold never threatened the monetary primacy of the dollar. For 50 years, this arrangement held. Gold was treated as a commodity, not money. Central banks leased their gold into the market to generate yield. Bullion banks used that leased gold to short the market and cap rallies. Western investors were taught that gold was a barbarous relic, a hedge for doomsday preppers, not a serious asset for modern portfolios. Meanwhile, Washington could print unlimited dollars, finance endless deficits, and sanction any country that challenged the system. But something changed in the years following the 2008 financial crisis. Central banks in the developing world stopped selling gold. They started buying. Russia began accumulating hundreds of tons per year. China's official reserves grew steadily, though analysts believe their actual holdings are far higher. Turkey, India, Poland, Hungary, and a dozen other nations joined the buying spree. They weren't buying gold as an investment. They were buying it as insurance against a dollar system they no longer fully trusted. And then came the sanctions. In 2014, Russia was partially cut off from the dollar system after Crimea. In 2018, Washington withdrew from the Iran nuclear deal and reimposed crushing sanctions. In 2022, after the conflict in Ukraine, the United States and Europe froze $300 billion in Russian central bank reserves. They didn't seize Russian assets because of a legal judgment. They froze them because they could. That decision sent shockwaves through every central bank on the planet. If Russian reserves could be frozen, so could anyone's. What followed was predictable to anyone who understands how power works. Countries with tense relationships with Washington accelerated their gold purchases. But they also did something more important. They started repatriating their gold from London and New York. Germany repatriated its gold from the Federal Reserve ahead of schedule. Turkey pulled gold back from the U.S. Poland, moved tons from the Bank of England to Warsaw. These weren't symbolic gestures. They were insurance policies against a financial system weaponized for geopolitical leverage. For decades, this system seemed unshakable. The dollar was the only game in town. London was the center of gold liquidity. The West controlled price discovery. But something changed. And now, 1,000 tons have left the system in 60 days. The cracks are no longer theoretical. They're measured in missing metal. Let's talk about what actually happened. In mid-October, LBMA vault data showed total holdings just under 35,000 metric tons. By mid-December, that number had dropped below 34,000 tons, a loss of over 1,000 metric tons in roughly 8 weeks. To put that in perspective, annual global mine production is around 3,000 tons. In 2 months, a third of 1 year's global mine supply vanished from the London vaults. This isn't normal seasonal movement. Gold doesn't drain from London at this pace unless something is structurally broken. Historically, LBMA inventory fluctuates, but moves of this magnitude are rare. The last comparable drawdown occurred in 2011, during the European sovereign debt crisis, when investors feared the collapse of the Eurozone and fled into physical metal. Even then, the pace was slower. The current drawdown is faster, sharper, and happening in an environment where official narratives insist everything is fine. Where is the metal going? Official reports describe it as normal flows, routine transfers, market balancing. But whispers from the bullion trade tell a different story. Asian buyers are paying premiums for immediate physical delivery. In a liquid market, premiums for physical overpaper should be minimal. When premiums spike, it means paper claims are losing credibility. It means buyers want the metal in hand, not a promise on a screen. Shanghai gold premiums have been elevated for months. Normally, gold trades at a slight discount in China due to capital controls. But recently, Chinese buyers have been willing to pay above London spot prices. That's a red flag. It means either supply is tight or trust in Western paper gold is falling. Likely both. Reports from refining centers in Switzerland indicate increased flows of gold heading east. Bars are being refined from 400-ounce London good delivery bars into smaller kilo bars preferred in Asian markets. India's gold imports surged in recent months despite government efforts to reduce the trade deficit. Official customs data shows hundreds of tons entering the country. But even those numbers may understate reality, given India's long history of informal gold channels. The United Arab Emirates has become a critical hub, with Dubai and Abu Dhabi facilitating flows between West and East. Metal lands in the UAE, gets refined or recast, and moves on to final buyers in Asia. The infrastructure for physical settlement is being rebuilt outside London and New York. Why is this happening now? The official explanations are tepid. Analysts cite seasonal demand, central bank diversification, and portfolio adjustments. But those explanations don't account for the speed or the scale. 1,000 tons in 60 days isn't diversification. It's a scramble. It's what happens when players with inside information move first and move fast. Let's examine the economic motivations. Central banks in emerging markets are sitting on massive dollar reserves. Those reserves are losing purchasing power due to inflation. U.S. monetary policy, driven by domestic political concerns, doesn't account for the inflationary impact on countries holding dollars. When the Federal Reserve prints trillions to bail out banks or finance deficits, it's a stealth tax on every foreign holder of dollar assets. Gold offers an escape. It's no one's liability. It can't be printed. It can't be frozen by a hostile government. For a central bank in Asia, the Middle East, or Latin America, swapping dollars for gold is a rational hedge against both inflation and geopolitical risk. But there's a limit to how much gold is available. And when everyone tries to exit the same door at once, the door gets jammed. That's what we're seeing now. There's also a currency dimension. The The dollar has been strong relative to other fiat currencies, but that strength is largely a function of relative weakness elsewhere, not dollar health. The euro is struggling. The yen has collapsed. Emerging market currencies are under pressure. In this environment, gold becomes the neutral reserve asset. It doesn't depend on any single nation's fiscal discipline. It doesn't carry political risk. It's the ultimate non-aligned store of value. Then there's the geopolitical calculation. We live in a world where economic weapons are used as freely as naval blockades once were. Sanctions are the new siege. Asset freezes are the new cannon fire. Countries watching the weaponization of the dollar system are drawing obvious conclusions. If your reserves can be frozen, they're not really yours. Gold held in your own vault is. This isn't paranoia, this is rational statecraft. But there's something more important. We're not just talking about central banks hedging risk. We're talking about a loss of faith in the paper gold market itself. For decades, the price of gold has been set not by physical supply and demand, but by trading in futures markets and over-the-counter derivatives. The COMEX in New York and the LBMA in London allowed enormous leverage. A single ounce of physical gold could back dozens of paper claims. As long as redemption rates stayed low, the system worked. Banks could suppress price, cap rallies, and ensure that gold never challenged the dollar. But what happens when redemption requests spike? What happens when holders of paper gold start asking for physical delivery? The system breaks. That's what's happening now. The drawdown in London isn't just about central banks buying. It's about the unwinding of leverage in the paper market. It's about a fractional reserve system for gold collapsing under its own weight. Consider the structure of the LBMA. Most gold held there is unallocated. That means you own a claim on gold, but not specific bars. The bank owes you gold, but it's fungible. It's pooled. If everyone showed up demanding their metal at once, there wouldn't be enough. It's the same logic as a bank run, except the banks involved are bullion banks, and the deposits are metal, not currency. When confidence cracks, the unallocated holders scramble to convert to allocated. And allocated means physical bars in a specific vault with specific serial numbers. That requires actual metal, and metal is finite. What traditional media is not reporting is the quiet panic among bullion banks. These institutions have massive short positions in gold. They've been betting on stable or declining prices for years. But as physical demand surges and inventory drains, those short positions become liabilities. Covering a short position in gold isn't like covering a short in a stock. You can't just print gold, you have to find physical metal. And if the metal isn't available, you face a squeeze. There's another layer. Central banks and sovereign wealth funds have been negotiating directly with miners and refiners, bypassing the London market entirely. These are private deals, off exchange, with metal going straight from mine to vault without ever touching LBMA inventory. It's a parallel market, invisible to official statistics. When you see inventory falling in London, you're only seeing part of the story. The real story is that the entire architecture of price discovery and settlement is moving east. China has been preparing for this for years. The Shanghai Gold Exchange operates on a physical delivery model. Every contract settled there requires physical metal. There's no leveraged paper market. It's real metal, real vaults, real settlement. For years, Western analysts dismissed Shanghai as a regional market. But as LBMA inventory drains, Shanghai is becoming the center of gravity. The price of gold may soon be set not in London or New York, but in Shanghai. That shift would be as significant as the end of Bretton Woods. There's also the quiet coordination happening between non-Western powers. Russia and China have been trading in their own currencies, reducing dollar dependency. The BRICS nations have discussed creating a commodity-backed trade currency. Gold would likely play a role. If a significant portion of global trade begins settling in a currency with gold backing, even partial, the demand for dollars falls. And if demand for dollars falls, the Fed's ability to print without consequence diminishes. That's an existential threat to American financial hegemony. In recent months, there have been reports of gold moving from Switzerland to China at record rates. Swiss refiners are working overtime, recasting Western bars into forms acceptable to Eastern buyers. These refiners are the choke point. They're the only ones capable of processing the volume. And they're running at full capacity. That tells you the demand is real, sustained, and large. What comes next is crucial. If the LBMA inventory continues to fall at this pace, we'll reach a point where the market can no longer function as the global price setter. Liquidity will dry up, bid-ask spreads will widen, volatility will spike. At some point, a bullion bank will fail to deliver on a contract. That's when the crisis becomes visible. Until then, it's a slow-motion unraveling, hidden in vault data that most people never look at. The implications for the dollar are profound. The dollar's dominance rests on the need for other countries to hold dollars, to buy oil, to settle trade, to hold reserves. But if gold becomes the preferred reserve asset, the demand for dollars falls. If central banks swap treasuries for metal, who buys U.S. debt? If the Fed can't find buyers for treasuries, interest rates spike, the government can't finance deficits, and the entire fiscal structure of the American state comes under pressure. This is where the story gets really interesting. We're not just watching a commodity market move. We're watching the foundation of the global financial system shift beneath our feet. The people draining London's vaults aren't doing it on a whim. They're doing it because they see what's coming. They see the debt levels. They see the money printing. They see the geopolitical fractures, and they're getting out while they still can. At this point, I need to step back from emotion and look at this through a realist lens. In international relations, there's a framework that explains state behavior in competitive systems. States act rationally to maximize security and power. When the structure of the system changes, states adjust their strategies. For decades, the unipolar moment allowed the United States to set the rules. Gold was demonetized, the dollar was king, but unipolarity is ending. We're entering a multipolar world where power is more evenly distributed. In a multipolar world, states can't rely on the goodwill of a hegemon. They have to self-insure. That means diversifying reserves. That means reducing dependence on any single currency or system. That means holding assets that can't be weaponized against you. Gold fits that bill perfectly. It's not about conspiracy. It's about the logic of anarchy in the international system. When you can't trust the hegemon to act in your interest, you take steps to protect yourself. The United States is still the most powerful country in the world, but power is relative and contextual. America's ability to print dollars without consequence depends on others accepting those dollars. If they stop accepting them or demand gold instead, the game changes. Economic power is built on trust and network effects. When trust erodes, network effects can reverse. The very architecture that made the dollar dominant can become a vulnerability when others coordinate to exit. We've seen this before in history. The British pound was the global reserve currency for over a century. But 2 world wars, mounting debts, and the rise of a new hegemon ended that. The transition wasn't smooth. It involved crises, devaluations, and a painful adjustment. The dollar's dominance has lasted 80 years. But nothing lasts forever. The question isn't whether the transition will happen. The question is how disruptive it will be. What's happening in London is an early warning. The smart money is moving. Central banks are moving. Sovereign wealth funds are moving. They're not waiting for the crisis to hit the front page. They're positioning now, while there's still metal to buy. The average investor, the pension fund, the retail saver, they'll move last. And by then, the price will have already adjusted. That's how these transitions work. The insiders move first. Everyone else pays the cost. This framework also explains why Western governments and financial institutions are downplaying the significance of the LBMA drawdown. Admitting that gold is flowing east at this pace would be admitting that confidence in the dollar system is eroding. It would be admitting that the architecture of financial power is shifting. Central banks don't want to trigger a panic, so they stay quiet. They call it normal flows. They hope the bleeding stops before it becomes a hemorrhage. But hope isn't a strategy. The logic of the situation is clear. If you're a central bank in Asia and you see the writing on the wall, you buy gold. If you're already holding gold in London, you repatriate it. If you're a sovereign wealth fund, you shift from paper assets to hard assets. These are rational decisions in a changing world. And because they're rational, they're predictable, which means this trend is likely to continue until something breaks. History tells us that when reserve currency systems transition, there's a lag between the decline of the old hegemon and the full recognition of that decline. Britain was declining for decades before the world fully shifted to the dollar. The dollar could decline for years before a new system fully emerges. But the transition is happening. The gold flowing out of London is proof. The realist perspective also tells us to watch what states do, not what they say. Official statements will reassure markets. Analysts will call this normal. But the actions speak louder. 1,000 tons in 60 days is not normal, it's a signal. And the signal is clear. The era of unquestioned dollar dominance is ending. The era of gold as a monetary asset is returning. The actors who understand power are moving accordingly. What we're witnessing is not irrational panic, but rational adaptation to a new distribution of power. When the rules of the game change, the players change their strategies. The game is changing, and the players are moving. This isn't just about London. The consequences will affect every person holding dollars, every saver in a Western bank, every pension fund betting on stable treasury yields. When central banks dump treasuries to buy gold, bond prices fall. When bond prices fall, interest rates rise. When interest rates rise, debt service costs explode. The U.S. government is already spending over $1 trillion a year just on interest. If rates rise further, that number becomes unsustainable. For the entire region, this move signals a shift in the balance of financial power. Asia is no longer content to be the factory for Western consumption, paid in depreciating dollars. They want real assets. They want gold. They want control over their own monetary destiny. This has implications for trade flows, for currency stability, for the entire post-war economic order. The international financial system faces a credibility crisis. For decades, the system ran on trust. Trust that the dollar would hold value. Trust that treasury bonds were risk-free. Trust that the rules wouldn't change. But the rules did change. Sanctions taught the world that financial assets can be weapons. Inflation taught the world that central banks will sacrifice savers to protect debtors. And now, the gold drain is teaching the world that even the most liquid markets can seize up when everyone heads for the exit at once. In the next 5 to 10 years, we'll see more countries announce increases in gold reserves. We'll see more repatriation of gold from Western vaults. We'll see the creation of alternative payment systems that don't rely on dollars. We'll see gold play a larger role in trade settlement, either directly or as backing for new currencies. The dollar won't disappear overnight, but its dominance will erode. And with that erosion comes a loss of American ability to finance deficits cheaply, to impose sanctions costlessly, and to set the rules of the global economy unilaterally. For individuals, this means the price of gold is likely heading much higher, not because of speculation, but because of fundamental shifts in demand from the largest, most sophisticated buyers in the world. Central banks don't chase momentum. They buy for strategic reasons. And they're buying now. If you're holding cash, you're holding a depreciating claim on future goods. If you're holding bonds, you're betting that governments can service debt in an environment of rising rates and falling confidence. Those are risky bets. Economic predictions are tricky, but some trends are clear. Energy prices will remain volatile as the dollar's role in oil markets weakens. Countries may increasingly settle oil trades in other currencies or directly in commodities. That reduces demand for dollars and increases inflationary pressure in the United States. Inflation isn't going away. It's structural now. The only question is whether central banks will fight it with rate hikes that crash the economy or accommodate it with more printing that destroys the currency. Political ramifications are already visible. Countries are forming blocs. The BRICS nations are coordinating. The Shanghai Cooperation Organization is expanding. These aren't just talk shops. They're building infrastructure for a post-dollar world. Payment systems, development banks, trade agreements that bypass Western financial rails. The world is fragmenting. And in a fragmented world, gold becomes the universal settlement asset because it's the only asset everyone trusts. Security calculations are shifting too. The U.S. military is still dominant, but military power is expensive. It's financed by borrowing. If the ability to borrow cheaply disappears, the ability to project power globally diminishes. Other nations see this. They're testing boundaries. They're building their own systems. They're less afraid of Washington than they were a decade ago. The gold drain is part of this larger story. It's a vote of no confidence in American-led financial architecture. The financial system impacts are the most immediate. If LBMA inventory continues to fall, there will be a reckoning in the derivatives market. Gold ETFs, futures, contracts, unallocated accounts. All of these are claims on a shrinking pool of metal. At some point, the math doesn't work. When that point is reached, there will be a scramble. Prices will spike. Contracts will default. Investors will realize that their paper gold isn't worth what they thought. That's when the mainstream wakes up. But by then, the easy money will have been made. London has demonstrated that the Western gold market is not as deep or as stable as advertised. What we're witnessing is not a temporary fluctuation or normal market activity, but a structural breakdown in the mechanisms that have kept gold suppressed and the dollar dominant for half a century. The vaults are emptying because the players who understand power have decided that paper claims are no longer sufficient. They want the metal. They want it now, and they're willing to pay up to get it. As realist analysis has shown us, when the distribution of power shifts, states adjust their behavior to reflect new realities. The unipolar world is fracturing, and London is positioning as a diminishing hub in a new multipolar reality. The gold flowing east isn't just metal, it's monetary sovereignty. It's insurance against a system that has been weaponized. It's a bet that the future of money looks more like the past than the present. This move marks a turning point. Historians will look back at this period and see it as the moment when the post-Bretton Woods dollar system began its terminal decline. The process will take years, maybe decades, but it has begun. And the evidence is measured in missing tons, in empty vaults, in premiums paid by buyers who see what's coming. The unipolar world is ending, and the actors who understand power are repositioning for the world that comes next. That world will be more chaotic, more competitive, and more dangerous, but it will also be more balanced. No single country will have the ability to print the global reserve currency and export its problems to the rest of the world. Gold is returning to the center of the monetary system not because of nostalgia, but because in a world of competing powers, it's the only asset that stands outside the game.